In this session, I'm going to walk through a valuation of Apple that I did with my students last week. In the process, I hope to underscore some of the major concepts from prior sessions. As you can see from the chart, Apple and many of the other FANG stocks have been strong performers recently. Apple stock is up 46% year to date, compared with the S&P 500, which is up just over 16%. Given the recent run, we thought it would be interesting to value the company. The recent performance has been driven, in part, by a new upgrade cycle. Apple, which generates 2/3 of its revenue from iPhones, just introduced the iPhone 8, 8 Plus, and 10. As you probably know, the typical upgrade cycle occurs every 2 years. That said, the class and I thought that the company may be entering a super cycle driven by new product innovation. More importantly, we didn't think the super cycle was reflected in the consensus estimates, so we set out to verify that assumption. We started by digging into the company's most recent 10-K and found that Apple disclosed $37 billion in payments related to supplier agreements. This is a 32% increase year over year and consistent with the last supercycle, which occurred in late 2014 and early 15 as part of the iPhone 6 upgrade cycle, when the company began introducing a larger form factor. Calling out this outsized purchased obligation signaled, at least to us, that the company expects strong demand for their new product offerings. Importantly, we didn't find this analysis in a review of recent street reports. Something else notable is that the iPhone 6 supercycle was supported by unit growth, but ASPs didn't change. With the iPhone 10 selling at more than $1,000, we expect sales to also be supported by higher ASPs. This view was supported by a Piper Jaffray survey of over 300 iPhone owners. The survey pointed to significantly higher upgrade intentions compared to a similar survey last year. In fact, nearly half of those surveyed indicated that they plan to upgrade, but haven't yet purchased the iPhone 8, suggesting that they may buy the iPhone 10 at the higher price point. A review of the company's 10-K also revealed that Apple expects to double services revenue by 2021. At $30 billion, services currently represents only 13% of Apple's total revenue. While a small piece of Apple's business, this is nearly as much revenue as generated by Facebook and more than Alibaba last year. Using management's targets, we estimate a 19% compound annual growth rate, or CAGR, for services over the next 5 years. The services segment has high margins. While not disclosed, the Street estimates services margins to be between 55 and 60%, compared to the company's overall margin of 38%. After our review, we settled in on two major thesis points. The first is that the company's sales will benefit from higher ASPs from the iPhone 10 and a continued shift to SKUs with larger screens and storage configurations. The second was that the product mix shift and rapid growth in services would lead to margin expansion over the next few years. As I discussed in a prior video, we need to link the tenets of our thesis to our model. In class, we worked through the process for Apple. For example, our view on higher units and ASPs from the supercycle translated into 20% revenue growth in 2018 and a 2018 to 26 CAGR of 3.7%. With mix shift to SKUs with higher price points and a larger contribution from the high-margin services business, operating margins are expected to expand from 27% today to 30% by 2019. With similar levels of capital intensity, free cash flow is then expected to grow at a CAGR of 7% over the next 10 years. Let's take a look at the model. This is a 3-stage DCF model with explicit forecasts for 2017, 18, and 19, and then a transition phase to a terminal value in 2026. To me, it seems reasonable to assume a high growth period of anywhere from 0 to 10 years. Beyond that point, it's hard to imagine that anyone could reasonably forecast free cash flow. Given the strength of Apple's brand and the almost cult-like following of its customer base, we used a 10-year forecast period. For the terminal value, we assumed a long-term growth rate of 2.3%, consistent with the yield on the 10-year Treasury bond. As noted earlier, we expect higher sales from the iPhone supercycle. The supercycle, combined with a mix shift to higher margin services segment, should result in margin expansion over the next few years. Obviously, we want to be sure that these figures that we use for revenue growth and operating income are backstopped. So we did a revenue roll-up for the company to be sure that our estimates were reasonable. We did the same for gross margins, looking at how the company's plan to double the services revenue would impact gross margins and ultimately the company's operating margins over the next few years. For reinvestment, we looked at the historical relationship between sales and the company's short and long-term investment needs. By deducting reinvestment needs from our after-tax operating income, we arrive at the company's free cash flow, which we expect to grow by 6.9% over the next 10 years. Discounting those free cash flows at the weighted average cost of capital of 9.3%, we arrived at a value for Apple of nearly $200, implying 17% upside from the stock's current price. Let's now look at the company's relative value. The company is currently trading at 15 times next 12 months earnings per share. To assess the current price multiple, we need to have a perspective on where the company has traded historically on both an absolute and relative basis. To gain that perspective, I've included a chart with the company's PE ratio over the past 5 years. The height of each bar reflects the range of the company's PE multiple during each calendar quarter. That's why there are 4 bars each year. The black line that bisects each bar is the average multiple for the quarter. As you can see, the company is trading near its 5-year high multiple. Not that it couldn't go higher, but we would have to make a case that the fundamentals for the company going forward are better than they've been over the 5-year period reflected here. That said, stocks trade at different multiples in different market environments. To capture this, we looked at where the company is trading on a relative basis and how that compares to where it has traded historically. This chart illustrates the company's relative multiple over the past 5 years. A relative multiple is just the company's multiple expressed as a percentage of the market multiple. Since the S&P 500 currently trades at 18 times next 12 months EPS, Apple at 15 times is trading at a 20% discount to the market. While we didn't superimpose the average relative multiple on the graph, the company usually trades at about a 20% discount to the market. In fact, over the past 5 years, the only time that it has traded in parity with the market was at the end of 2014, when the multiple expanded with the iPhone 6 supercycle. If we assume that the company is in a new supercycle, it'd be reasonable to expect that the company can get back to a market multiple. If so, the company would trade at $203. Note that I used earnings over the next 12 months rather than either a fiscal year 1 or fiscal year 2 estimate. This is because Apple does not have a calendar year fiscal. Rather, their fiscal year runs from October 1st to September 30th. By using next 12 months, we can standardize the estimates for differences in the fiscal year. I've included the calculation of the next 12-month estimates for both Apple and the S&P 500 in the notes section provided here. Also provided are our estimates versus consensus. Since we don't believe that the higher ASPs and margin expansion are fully reflected within consensus estimates, our estimates are higher. A summary of our valuation is provided here. As you can see, we did not include a COMPCO analysis. As the name implies, a comparable company or COMPCO analysis involves comparing the subject company, in this case Apple, to a group of comparable firms. The question, of course, is what's a good comp for a company like Apple? Is it Microsoft and other software companies in the S&P 500? Given the disproportionate revenues generated by Apple from iPhone sales, it might also include Verizon and other telecom companies. Or we may argue that the company should be compared to luxury companies, given that Apple competes with these companies for a share of the wallet, retail talent, and premier retail space. The Wall Street analyst reports that we reviewed incorporated anything from the 20 largest tech companies in the S&P 500 to a select group of luxury brands like Prada and Louis Vuitton. In the end, it seemed to us that they were cherry-picking companies to arrive at a value that was supportive of their recommendation. For that reason, we decided to rely on the methods outlined here and forgo a COMPCO analysis. Hopefully, you found this analysis of Apple to be helpful. The next question, of course, is whether there is enough margin of safety to compensate us for errors in our modeling and worse than average luck. The answer to that question will depend, in part, on our confidence in the inputs used in the model and whether we are absolute or relative managers. Thanks for listening.